Our marketing analyst this week is Steve Koontz from Colorado State University. We learned in the USDA's November crop report the agency was estimating the 2013 U.S. corn harvest to be a new record at nearly 14 billion bushels. Soybean production was forecast at nearly 3.26 billion bushels, which would be the third largest on record. But as they have been for some time now, soybean stocks are incredibly tight, only 170 million bushels for 2013-2014. When we talked at the four-state crop insurance workshop in Grand Island Wednesday, I asked Steve to weigh the upside and downside potential for soybeans with short supplies on hand, but also with a big U.S. harvest in the books and potentially the biggest haul yet to come in South America.
I think the markets they're really pricing that downside potential. So I think the downside is what you see when you look at futures. But if you really factor in a variety of but what ifs, there's more upside potential for soybeans. And that comes from, if you look at the weather maps, South America, like us, doesn't have excess moisture to work with respect to soybean production. So they're going to need timely rains, and any sort of problem is going to create it will create a supply event for them.
That's one of the but what ifs situations.
Yeah.
How much is meal and oil keeping up soybeans right now?
Meal is the driver. It's been the strong one. Oil has not. Oil usually moves along with the general domestic economy. That's been pretty soft. The protein economy, the demand for hog feeding and dairy side has been pretty strong and has been driving that bean price.
I asked you about the upside, downside in soybeans. What about in corn? How do you weigh the upside versus downside potential in corn?
I really think it's almost all upside potential at this stage. I think we've talked that corn crop down. Mm-hmm. We spent all summer talking about, we might have $4 corn, and then we might have $4.50 corn, and then we might have $3.80 corn. We've simply talked it down all year long. And if you look at the supply-demand balance sheet, if you look at all the details, what you see is that prices are pretty low compared to the underlying fundamentals, and all you really need is a little bit more demand on the feed use side and a little bit more demand on the export side. I think we'll have some demand on the ethanol side. There'll be some margins there, but all those users of corn have reasonably strong margins, and I would expect the demand side to go up some. I would also expect, we've got a lot of corn that's been going into grain bins. And we're going to sell enough out of the field that doesn't fit in our production and marketing system. But as soon as that dries up, we'll see stronger corn prices. One of the things we are also seeing that fits with that story is we have pretty strong basis, the cash relative to futures. We've got cash that's pretty strong relative to futures, and it's been that way for a year. So what we really need is to get the harvest in, and then to need to pull corn out of the bins, and once we do that, we'll see some price strength.
With both corn and beans after this harvest, where would you be aggressive at selling with this crop right now? Is there a level that you try to target right now?
I might push it off until what I didn't sell out of the field at harvest, I might push into next year. I might push into February, March, something like that. It really depends on where producers are located. Look at your historical basis. If you have a time period that's typically strong historical basis, plan on doing some pretty aggressive marketings there.
What about in 2014? How do you see the levels for corn and beans moving once you get closer to that 2014 planting and potential acres that you'll see next year?
Boy, I really hate to cop out on that answer, but I'm going to have to. We just don't know. We have beaten down corn prices a lot. And on into 2014. We're talking about $4.70, $4.80 for D14 corn this week, and that's really pushing break-evens for quite a few operations. So what really matters is how many acres are scaled back, what can producers do to renegotiate cash rents, or not renegotiate, but not simply give away, not pay the rates that they've paid in the past as far as cash rents go. And then there's a matter of, so when all that plays out, what kind of planted acres do we really get? In my mind, we could have pretty healthy plantings for next year, or we could actually cut back pretty substantially. All the other crops look pretty good compared to corn. The hay budgets look good, the wheat budgets look good, even bean budgets probably look better than corn. So I could easily see additional acres going to all those crops. And that's what matters for next year, is how many of those acres pull out of corn and go somewhere else, or are fallowed or something along those lines. So I think we're, as far as the 14-15 crop goes, we're going to have a lot of volatility. We're going to have reasons to really push that price up. We're going to have reasons to really push it down. But my bias is really on the downside, and be much more aggressive on forward selling than we did through 14.